Welcome. In this video, can XCN go up 630% in the next wave? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
When measuring from bottom to top with the Fibonacci tool, the price pulling back to the 0.786 level actually carries quite critical and deep meanings in technical analysis. Because Fibonacci levels not only show mathematical ratios in the markets, but also reveal investor psychology, the balance between buyers and sellers, and the possible reversal zones of price. Especially the 0.786 level is considered an extremely important retracement area for many investors. The reason is that after giving back most of the upward move that started from the bottom, the price still holds the potential for continuation. In other words, when this level is reached, it is often seen as a turning point in the eyes of investors. If the price gives a strong reaction here, the upward movement may restart with much greater strength. The 0.786 level is often referred to in the markets as the last chance area, because when the price breaks below stronger and more commonly used levels like 0.618, investors usually don't think the uptrend has completely ended. Instead, they see it as a deeper retracement that could end around the 0.786 level. That's why, when the price reaches this point, many eyes are focused on it. Big investors, institutional buyers, or traders who believe in the continuation of the trend are often eager to open positions here. A reversal from this level could mean not just a small reaction, but the start of a much bigger and stronger trend. Especially in Fibonacci retracements drawn from bottom to top, the 0.786 level carries great importance both technically and psychologically, because when the price retraces this deep, it has actually given back nearly the entire upward move. On the surface, this may look negative, as many investors interpret such a deep retracement as a sign of weakness. However, the key point here is that strong trends in markets often continue much more aggressively after such deep pullbacks. So if the price holds at 0.786 and turns upward, it shows that buyers are stepping in heavily in this area, which can spark a new bullish uptrend. In addition, reversals from 0.786 level often punish impatient investors. When the price breaks below well-known levels like 0.618, many traders panic and close their positions thinking the uptrend is over. But during this time, patient investors who understand deeper Fibonacci points wait for the 0.786 level. When price reaches it, a strong reversal may happen, and impatient traders miss the opportunity. This is a very common scenario in markets, because the market has always rewarded the patient and knowledgeable rather than the majority. Another reason why the 0.786 level often triggers a strong reversal is that it usually coincides with support or resistance areas on larger timeframes. So it's not only the Fibonacci ratio, but also the historical horizontal levels that reinforce this zone. If these two factors overlap at the same point, the probability of a price reaction increases significantly. Reactions from such confluence zones are usually fast and strong as buyers enter the market heavily. Reversals from 0.786 also help restore market confidence. If the price holds here, it creates the perception among investors that the trend isn't over yet. As this perception spreads, more traders start buying again, pushing the price higher. This creates a chain reaction. First, the technical traders who understand this level step in, then others follow as they see the price rising, and the bullish wave grows stronger. The 0.786 level also has a connection with Elliott wave theory. According to Elliott, price movements often consist of a 5-wave impulse and a 3-wave correction. During these corrections, Fibonacci levels are commonly used to estimate how far price will retrace. It is quite common for the second wave or the B wave to retrace to the 0.786 level before reversing. This shows how different tools in technical analysis often support each other. On top of that, reversals from the 0.786 level provide very attractive risk-to-reward setups for traders. Because once price starts moving up from this level, the stop loss is usually placed just below 0.786. This allows the trader to keep risk at a minimum while targeting much larger gains. In other words, entries from here offer the chance for high returns with relatively low risk. This setup occurs even more frequently in the crypto market, where price action is far more volatile and aggressive compared to traditional markets. It's common for crypto prices to retrace to deep levels like 0.786 before restarting a strong rally. Traders are aware of this volatility, which is why they give extra importance to this level. Reversals from here often lead to sharp upward moves and quick new highs. In conclusion, when Fibonacci is drawn from bottom to top and the price is at the 0.786 level, it shows that the market is at a highly critical point in technical analysis. A reversal from this area could reignite the uptrend and drive the price higher. Investor psychology, technical confluence, alignment with Elliott waves, and attractive risk-to-reward ratios all strengthen the probability of a reversal here. Therefore, the price being at this point now may signal the potential start of a strong rally ahead. A bounce from here could ignite a new bullish cycle and create significant profit opportunities for traders. But we can't base our decision only on Fibonacci. Let's also take a look at other metrics. Stay tuned.
When an upward crossover occurs in the MACD indicator, it is considered a highly significant signal in technical analysis because it provides strong clues about the market's direction. MACD, or Moving Average Convergence Divergence, essentially tracks the convergence and divergence of moving averages, offering investors insights into price momentum and trend strength. At its core, it consists of two main lines, the MACD line and the signal line. These two lines reveal the momentum and direction of price movements, and their crossovers indicate the start of a new trend in the market. In particular, when the MACD line crosses above the signal line, it is generally seen as a sign that a strong upward move may be beginning. The reason is that short-term momentum is overtaking long-term momentum, which shows that buyers are becoming more dominant in the market. This kind of crossover essentially represents a shift in power from sellers to buyers. Price momentum is increasing, and charts that previously showed pullbacks or sideways movements now carry the potential for upward acceleration. The upward movement of the lines is not merely a crossover, but also an indication that price is beginning to gain speed and that investors are showing stronger buying appetite toward higher levels. For this reason, when the MACD makes a bullish crossover and the lines continue rising, stronger evidence emerges that the market is entering an uptrend. Especially if this occurs as prices rebound from bottom regions, it serves as powerful confirmation of the trend's continuation. After bullish crossovers, another element investors often pay attention to is the histogram. The histogram represents the difference between the MACD line and the signal line, and if the lines have crossed and are moving upward, the histogram bars are expected to move above the zero line. This indicates that momentum has shifted into positive territory and that the market is gaining stronger upward energy. In such cases, investors consider not only that an uptrend has begun, but also that it may be sustainable. In this context, the signal provided by the MACD should be seen not merely as a single indicator, but as the beginning of a broader trend reversal. The upward movement of the lines also has a major impact on investor psychology. Since many traders and investors follow MACD, the crossover moment often triggers collective buying behavior in the market. When many participants simultaneously notice the signal, the probability of prices rising becomes stronger because the supply-demand balance shifts and buyers take control. As a result, prices start to gain upward momentum. This psychological effect is one of the key reasons why MACD crossovers work so powerfully. In other words, beyond being a purely mathematical indicator, it influences investor behavior and creates actual movement in the market. In addition, when examining how this bullish crossover reflects on the price chart, one usually begins to observe a pattern of higher lows and higher highs. This is a classic sign that the market has entered an uptrend. Price movements now bounce upward from stronger support levels. Each new high forms above the previous one, and investor confidence steadily increases. In this process, buying appetite grows, seller pressure weakens, and prices are pushed even higher. In such an environment, a bullish crossover on the MACD can indicate that the trend is only just beginning and that significant upside potential lies ahead. Of course, the continued upward movement of the MACD lines after the crossover may signal not just a short-term reaction, but the beginning of a longer-term uptrend. This is because it demonstrates that momentum is rising consistently and the market is gaining strength. Especially when prices move strongly upward from support levels, trading volumes increase, and other indicators confirm the signal, the bullish crossover of the MACD becomes an even more reliable sign. For this reason, after such a crossover, investors can expect prices to rise further and may open long-term positions. When we examine price movements within an ascending channel structure, the picture that emerges can actually signal a very strong bullish trend from a technical analysis perspective. This is because an ascending channel formation shows that buyers are gradually increasing their pressure, while sellers, though trying to suppress the price, are losing strength. The lower boundary of the channel serves as strong support, while the upper boundary becomes a resistance zone that the price targets. If the price manages to stay above the midline, it signals not only that the bullish momentum is being maintained, but also that it is gaining strength. Staying above the midline indicates that the market is still strongly supported by buyers and that investors, ignoring the selling pressure, continue to show appetite for upward movement. If the price pushes toward the upper boundary with this momentum, it signals a major upside potential for investors. In your example, if the price reaches the upper band, we are talking about a massive increase of approximately 630%. This ratio points to much more than an ordinary rally because it may not only suggest short-term gains, but also confirm a long-term trend. The ascending channel formation is one of the most watched structures in technical analysis because it clearly reveals the overall direction of the market. Instead of a sideways market, when higher lows and higher highs consistently form, it indicates the strength of the trend. Especially when the price holds above the midline, it means buyers have prevailed over the selling pressure. This boosts investors' confidence and encourages new buying. In such a scenario, the price's journey toward the upper band becomes almost inevitable. From a psychological standpoint, people generally want to join the winning side. Since staying above the midline already signals strong bullish momentum, further investor participation can trigger a sharp upward breakout. The possibility of a 630% rise shows just how great the potential of the price movement really is. To better understand such a rally, it's important to evaluate how channels function technically. An ascending channel consists of three main parts: the lower band, the midline, and the upper band. The lower band is where the price consistently finds support and bounces upward. The midline is generally where the price gathers strength after corrections. The upper band is the target level, the ceiling that investors expect the price to test. When the price trades above the midline, it confirms that the rally is not only intact, but also likely to continue strongly toward the upper boundary. At this stage, market participants stop focusing on the lower band, their eyes shift entirely to the upper band. Expectations then push the price higher, acting as a psychological catalyst. This is why holding above the midline is such a critical technical signal. Especially when talking about a potential 630% rally, it's clear that the market may have extraordinary potential. Moves of this magnitude usually appear not in ordinary price fluctuations, but during trend reversals, major bull runs, or long-term rally periods. The ascending channel structure is already a trend indicator in itself, but when the price breaks above the midline and heads toward the upper boundary, this structure becomes even stronger. As investors recognize this, buying pressure multiplies. In technical analysis, such scenarios often create chain reactions. As the price rises, new investors enter the market, which increases volume, strengthens momentum, and drives the price even higher. This cycle can push the price far upward, making enormous gains like 630% possible. Such a rally also has a strong psychological impact on investors. People tend to take risks to avoid missing out on huge profit opportunities. When they see a price move not just holding in the middle of a channel, but heading toward the top, many investors jump in with a fear of missing out mentality. This causes the price to rise faster and more sharply. In such an environment, technical indicators usually generate signals favoring the bulls. Volume increases, momentum indicators turn upward, and trend lines remain firmly intact. This strengthens the sustainability of the rally. In other words, the longer the price stays above the midline, the more likely it is to reach the upper boundary, and the more realistic the extraordinary 630% upside potential becomes. The midline of an ascending channel also reflects the health of the trend. If the price holds strongly in this region, it means the rally is not merely speculative. Instead, buyers truly dominate the market, and the upward move is built on solid ground. This makes investors think more long-term. In such conditions, medium and long-term investors start to play a larger role than short-term traders. This makes price movement more stable and strengthens the likelihood of a massive 630% rally.
From a technical standpoint, it is also possible that the price could break through the upper boundary in such a scenario. If the price reaches the upper band and does not encounter heavy resistance there, it could spark a new rally beyond the channel itself. In other words, the 630% target may only be a stage with higher potentials coming into play. When the price continues above the ascending channel, it is often considered the start of major bull trends. From this perspective, holding above the midline and moving toward the upper boundary can signal both short-term profit opportunities and the beginning of long-term major bull rallies. Another important point is that once the price breaks above the midline, stop-loss levels are also pushed higher. This means that risk for investors gradually decreases. As the price rises, stop-loss levels are adjusted upward, minimizing potential losses in case of a pullback. This makes investors feel safer and encourages additional buying. As a result, the rally strengthens not only technically, but also psychologically. As long as the price stays above the midline, confidence builds, the move toward the upper band accelerates, and the possibility of a 630% surge becomes an increasingly likely scenario. In conclusion, within an ascending channel structure, the price trading above the midline is a very strong bullish signal from a technical perspective. It increases the probability of the price moving toward the upper boundary, and if this journey unfolds as you described, it could reveal an extraordinary potential upside of 630%. This is not just a possibility, but also proof that the market is strongly controlled by buyers and that the uptrend rests on solid foundations. For this reason, such a scenario opens the door to both short-term profit opportunities and long-term major bull rallies. As long as the price holds above the midline, market optimism is preserved, expectations strengthen, and the price's arrival at the upper band becomes an increasingly likely scenario.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.